It's time for Money Tuesday. Stewart Welch from the Welch Group joins us, and we're talking about this question: is it time to maybe sell some of those stocks? Stewart, right now there's a lot of unrest right now. We've had a great run now, okay, in the bull market. People are saying maybe it's time, we're going to have that correction, but you're saying no, maybe not time to sell.
I think that's right, Mike. People are nervous and they're asking. I'm getting more questions about this, but I can think of a number of reasons why in the long term, let's say 3 to 5 years, stocks is going to be the place to be.
I know, and you talk about the Federal Reserve, because I know we're going to be watching that tomorrow too. Inflation reports come out and everything else.
Yeah, so the Federal Reserve has been easing on the bond buying, so but they are continuing to hold firm in terms of the Fed funds rate. So Fed funds rate's near zero. That's going to help keep interest rates low, and they intend to do that over a long period of time, so that's positive. You've got an improving economy, so it's pretty anemic, but it is improving. That's actually been really good for the stock market, that kind of slow improving economy. And then the jobs market is, while it's been pretty much a jobless recovery, jobs are improving. Unemployment is going down again at a very slow pace. So I think, again, that's really positive.
Okay, but a lot of those are not high-paying jobs. So I mean, that's something to keep in the mind. Right?
It's not great for the people that are getting jobs, but I can tell you from an economic perspective, it continues to show the economy is improving.
Okay, and you've touched on it, the historically low interest rates. Now, how long will those continue? What kind of impact can they have?
So that, I think, is probably one of the big things. The money's got to be somewhere. So if you're going to take it out of stocks, you're going to put it in bonds, CDs, or money market accounts, and those are at historically low numbers. If interest rates begin to rise, those are going to face headwinds. So it's going to be really hard to make money there, and I think it's going to continue to push people towards stocks, particularly now we have 80 million baby boomers headed for the retirement exits, and as they hit those exits,
excuse me,
and they want to replace that paycheck, they're going to look for, where am I going to get income? And I think it's going to come from big blue chip dividend paying stocks.
So if you're looking at your 401k, you're seeing what's going on overseas, you know that there's going to be a correction at some point. Now, I say correction, it may be minimal. You're saying, though, you shouldn't go in there and try to time something, right? Because that's where you can make a mistake.
I think particularly over the next 3 to 5 years, particularly for retirees, if you're a retiree, you want to keep 5 to 10 years worth of cash flow, what it takes to pay your bills, in fixed income. Everything else, I think, ought to be in blue chip dividend paying stocks. If it's in your 401k and you've got at least 5 to 10 years away from retirement, I would have it dominated by stocks, because that's going to be your odds on bet. That's your best bet.
All right, Stewart Welch, thank you so much.
Thanks, Mike.